Retirement is often imagined as a time of peace, travel, and enjoying life after decades of work. But the reality is more worrying, because according to Investopedia, only 37% of retirees are actually debt-free, which means nearly two-thirds of people are still paying mortgages, credit cards, car loans, or medical bills, even after leaving work. And this is a major problem since living on a fixed income with debts creates financial stress, reduces quality of life, and in some cases forces retirees back into part-time jobs. And to understand why this happens, we have to look at history and habits. Because in the UK and US alike, rising housing costs, student loans taken out later in life, and expensive healthcare have left many people carrying debt into their 60s and 70s. And surveys by the Office for National Statistics show that in the UK about 40% of households headed by someone over 65 still have outstanding credit commitments, while in the US Federal Reserve reports say the debt for people aged 65 and older has nearly tripled since the 1990s, showing this is not an individual problem but a generational one. Now, what can people do to avoid being part of the 63% with debt? First is planning ahead by making debt reduction a core retirement goal, because small steps like paying extra towards your mortgage each month can cut years off the repayment period. And this is crucial since mortgages are the largest debt many people carry into retirement. Second is controlling lifestyle debt, meaning credit cards, car leases, or personal loans. Since high interest rates eat into retirement income, and experts like Dave Ramsey often say, debt is not a tool, it is a trap, reminding us that carrying consumer debt only reduces long-term wealth. Third is building an emergency fund, because without savings, unexpected costs push people into debt. And research from Money Advice Service shows that households with at least 3 months of expenses saved are far less likely to rely on credit during retirement. Fourth is healthcare planning, especially in countries like the US, where medical bills can cause retirees to drain savings. But even in the UK, where the NHS covers most care, costs for dental, prescriptions, or social care can be heavy. So insurance or dedicated savings help reduce reliance on credit. Fifth is downsizing and asset management, where many retirees sell larger homes to clear mortgages and move into smaller properties, freeing equity while cutting costs, which has become common in the UK housing market where retirees release billions each year through equity release or downsizing. Sixth is working longer or part-time before retirement, which gives more years of income to pay down debts and allows pensions and investments to grow, since even 2 or 3 extra years can make a big difference. And seventh is financial literacy and early action, because starting young with budgeting, avoiding high-interest borrowing, and understanding pensions builds the foundation for a debt-free retirement. And statistics back this up, as a study by TransUnion found that people who make at least 1 extra mortgage payment a year reduce their total interest by up to 20% and finish their loans years earlier, while retirees who entered retirement mortgage-free reported higher levels of happiness and security than those still paying, proving debt-free living is not only financial but emotional.